I wanted to talk about apozones. I think it's really exciting, and it takes all the work out of adding support and resistance and drawing those lines for you. Not only does it just draw support and resistance, it makes it a zone. So you're a little bit clearer on an area to get into your trades, and also it defines your risk by putting a stop loss at the bottom of these lines or these zones, which I'll try to show you right here. When price made this swing low here, it created this support line. Not only did it create a support line, it created a demand zone. So what it's done is wrapped a little box around this candle here and created a zone, telling us more or less that there's no more buyers here. So as price rallied out of here, what you can do is wait till price returned to this area as it did here, and become a buyer, because you knew that before there was no more buyers, no more sellers in this area from this previous time. So as you become a buyer, price just rallies out of here. We use a moving average. You can use it for multiple reasons, to keep you in a trade, to get you out of a trade. But this big swing move here, you've seen a little bit of exhaustion. At this point in time, you could have lightened your load and taken maybe half of it off, and at least take a contract or two off, and use this moving average to keep you in this trade. Here we created another demand zone or support down here, and that's identified by this green box around it. So apozone does all this for you. Price rallied out of here, and then created a supply zone identified by the red lines around that. At that point in time, you could kind of tell that price was exhausted from this big swing move up. So you would either exit your full position or take another contract off and use this moving average as a stop. And as you can see, we created another demand zone in this area, and price hasn't broken that moving average. Price came back into this supply zone, and all this is being put on by apozones automatically on all your charts. So if you're trading crude, gold, any chart, any asset class that you're trading in any time frame, this is just the perfect thing for you. As you can see here, price started dropping below that moving average. At this point in time, it closed below it, and I would have been out of this trade. But even better is that you just go right up here, take this, switch to a 5-minute, and see if these zones align. It gives you more strength when price has hit multiple supply and demand zones or support and resistance zones on different time frames. So as you can see, I switched this down to a 5-minute time frame, and we can see this upper resistance zone more clearly and created by this candle here. And you can tell that this price rallied up into here and hit the very top of this. And if you're a short-term trader, that probably would have gave you a good signal to go short. And as you can see, price just dropped out of there, created another supply zone, rallied back up into there, but never broke the highs of it, and it would more or less keep you in the trade. But this is the end of the day. You may not wanted to take this trade initially. It still would have kept you in. You still would have made money. But that's how you can use multiple time frames to line and get synergy out of this. And that's apozones for you. And if you need more information, please contact us. We'll get it to you. Thank you.